Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, October 29th, 2016. So first of all, there's a couple of potential market moving events next week. November 2nd is Federal Open Market Committee rate decision, and on November 4th, Friday, there's an employment report. Don't forget the elections are on November 8th, so please don't forget to vote. And if you vote by mail, don't forget to mail in your ballots already. On Friday, we'll look at the intraday chart as FBI opened an investigation again into Clinton's emails report. Stocks prefer Clinton win to Trump win because of predictability of Clinton and complete unpredictability of Donald Trump. Currently, stocks are somewhat oversold, and we'll look at some of the funds which are already at Brexit lows. Finally, we'll look at bonds that are under pressure and may have actually become bearish. Then we'll go into Forex universe, and dollar have stopped dropping for now. Gold gained slightly, but GDX actually registered a loss despite the weaker dollar. And oil did reaffirm resistance in the $50 area. Then we'll look at natural gas, and then also I will introduce a binary options trading concepts on NADEX, North American Derivatives Exchange. So we'll start off with a 5-minute chart of E-mini 500, S&P 500 futures. And so this is a Friday, so we had a good GDP report and everything was doing just fine until all of a sudden FBI decided to reopen an investigation into some new emails that they found about Clinton, etc. Now you can see that this is a event that the stock market clearly did not like. We had a sell-off from the day highs towards the day lows. We found support more or less and then rallied and kind of closed indecisive in the middle. But the point I'm trying to make is the stock market strongly prefers Clinton win to Trump because Trump is very unpredictable, and his previous statements about trade agreements and NATO, etc., they're all sort of unpredictable, and people don't, and stock market participants don't really like unpredictability. With Clinton, it's pretty straightforward. She is a seasoned diplomat, and she is a good manager, basically. So stocks prefer a predictability to unpredictability, and if Trump does win in November, this could be a event similar to what we had during the Brexit. Because during the Brexit we had everything was jolly and fine, and then all of a sudden, right here, all of a sudden we had an enormous gap down and continuation lower after the Brexit, because Brexit was an unpredictable event. In any case, let's go back to our charts. This is S&P 500 ETF SPY on a daily time frame. I mean, this drop on Friday was not like huge, 0.3%, and we're still more or less above the lows from the September lows. So, we're kind of getting there, though. We're trying to, I think the price is trying to test the lows from, basically we're just testing a breakout here. So it's possible that we don't hold here, and then if we don't hold here, it's almost a guarantee that we're going to drop to the Brexit lows. And the reason for that is this could be viewed as a head and shoulders kind of pattern. The height of this pattern would be around 3.5%. If we break down 3.5% below, we're going to end up around the Brexit lows here. As far as the market breadth, so there are some concerns now as far as the market breadth is concerned. So we can see unbalanced volume is already leading the it's like a leading indicator, and we have advanced decline line and advanced decline volume lines. They both have a bit of a divergence. You can see that the price is not making lower lows, but the indicators are making lower lows. So we have a bit of a divergence. The divergences sometimes work out, sometimes they don't work out, but if this one does work out, this you know, exactly like I said, we could break this lows here and head towards the Brexit lows. We are somewhat oversold, and you can see this is intermediate term breadth momentum oscillator. You can see it's in the negative territory, so you can consider it as being oversold. And this is still very much a bullish security. S&P 500 is still very much a bullish security. So here's my proprietary market breadth index. We entered the new bull market back in June of this year, according to this system. And since then, you know, it has 5 inputs basically, or well, actually 4 inputs, because the lowest point is 1, so 4 inputs, and then some of those inputs have many additional inputs. So far, I didn't see any weakening of the market breadth index, and still we're still at 5. In other words, we're still very much bullish. One of the inputs that go into the market breadth index is, like I call it ROI-MBI, percentage of stocks in an uptrend. And it has been weakening a bit. So now we're at 61% percentage of stocks in an uptrend. And basically, I already look at it as somewhat oversold, because, you know, we are in an uptrend, we're close to all-time highs, and we are a bit overextended to the downside. So it's entirely possible that we do find support here and just rally higher. And I think the catalyst for that could be maybe more polls showing Clinton in the lead, or possibly a very good unemployment report next week. Here's a little bit of a bullish divergence on RSI. You can see we had a lower low here, but we now have a higher low here, while we didn't really make a higher low on the index itself. And again, like I said, in the long term, you can see longer term percentage of stocks in over 200-day exponential moving average. The bullish percent index are still well within the bullish areas. We're not even below 50%, although bullish percent index did drop to 55, which is the lowest reading since maybe July here. So, but again, we're not even below 50%, so we're still well in a bull market territory. Okay, this is S&P 500 on a weekly time frame. So we are again back to the breakout levels, and the breakout levels here, it was 2134, we're basically there. So it looks like we are retesting the breakout levels. We broke out to all-time highs, and now we are 1, 2, 3, 4, 5 weeks at the breakout level. So if we do hold here, this will become a very strong support. If we don't hold here, like I said, we could easily retest maybe like around this area, maybe even Brexit lows. Now, as far as higher beta stocks, this is QQQ. This week we actually registered an all-time high. So all-time highs are showing good market participation and good appetite for risk. We are getting a little bit of a divergence. The advanced decline line made a slightly lower low. How significant it is, it's difficult to say, but this is a very top-heavy index. You can see the Apple accounts for 12%, etc. So top 10% account, you know, for 50% of the index. So basically, this top 10 stocks is what determines the fate of QQQ. But in any case, so far I see now major problems with the index, and, you know, all-time highs again are quite bullish. Right. So there are some concerns, obviously, in the markets right now, and that is, I think, the biggest problem right now is the Russell 2000, which could be looked from 2 points of view. So one is that we have indeed broken support, and this is the support, the lows from August. The alternative view is we could say that we're simply retesting the breakout level, and this breakout level came from you know, June highs and a breakout right here in July. So we basically filled this gap. So right now it's kind of difficult to say. Maybe this is support break, maybe there's just simple retest of the breakout level. Again, we're somewhat oversold. As far as divergences, I don't see that many. It's more or less congruent. But the other thing you have to remember is the small caps universe accounts for something like under 20% of the entire United States investable universe. So it's not a very big part of the stock market, surprisingly. Some funds are already down to the Brexit lows. So here's one, which is real estate, and this one is more economic, or rather more interest rate sensitive than the rest of them. And when we look at bonds, you'll see that bonds are under pressure. So basically, we are back to the Brexit lows. I think there's strong support here in the 70 whatever $4 area, and we're kind of getting there more or less. So from all-time highs, we kind of came down relatively hard. So let's just measure how much we came down from all-time highs, and that is 11%. So it's pretty, we came down pretty hard. So it's a decent correction. So it's possible we're going to find support around here, basically. The other sector of issue is the healthcare. This one has just been pressured stronger and stronger, and this one may have broken already below Brexit lows, because we closed at 67.78 on Friday, and the lows here were at 67.83. So it's possible we already broken below those support. Also, there is larger volume here, and that makes perfect sense because people hide their stops below recent lows. So basically, we took out the stops here. So this volume could be already indicating that it is indeed a bottoming action. Now again, I think that this is a bullish chart, and I think this is already more or less oversold. So I think at the very least some sort of a bounce may materialize from these levels, unless the entire market just collapses. Here's another one that's more or less back to Brexit lows, the minimum volatility fund. This one was also at all-time highs, so it came down rather hard, and kind of basically again at support more or less. Then here I wanted to show that even though this is a large volume, does not necessarily mean that this is indeed the bottom. And here's a good example of that. USMV, you can see there was an enormous volume spike here in October, around right there, and it did not indicate a bottom in prices. In fact, we broke below those prices. So I would read bottoming, I would read volume kind of with a grain of salt. They could be interesting and useful, the volume patterns, but they're not necessarily 100% guaranteed. Here's another industry group which came down pretty hard, also more or less a little bit more interest sensitive than the rest of them. That's Homebuilders, again also back to the Brexit lows, and we'll see where this goes. These are economically sensitive and interest rate sensitive, so kind of like a double whammy here. But to summarize, S&P 500, I think it's still bullish, especially if we hold support here. We could easily come back and re-challenge all-time highs. Great. So there are some concerns, obviously, in the markets right now, and that is, I think, the biggest problem right now is the Russell 2000, which could be looked from 2 points of view. So one is that we have indeed broken support, and this is the support, the lows from August. The alternative view is we could say that we're simply retesting the breakout level, and this breakout level came from June highs and a breakout right here in July. So we basically filled this gap. So right now it's kind of difficult to say. Maybe this is support break, maybe there's just simple retest of the breakout level. Again, we're somewhat oversold. As far as divergences, I don't see that many. It's more or less congruent. But the other thing you have to remember is the small caps universe accounts for something like under 20% of the entire United States investable universe. So it's not a very big part of the stock market, surprisingly. Some funds are already down to the Brexit lows. So here's one, which is real estate, and this one is more economic, or rather more interest rate sensitive than the rest of them. And when we look at bonds, you'll see that bonds are under pressure. So basically, we are back to the Brexit lows. I think there's strong support here in the 70 whatever $4 area, and we're kind of getting there more or less. So from all-time highs, we kind of came down relatively hard. So let's just measure how much we came down from all-time highs, and that is 11%. So it's pretty, came down pretty hard. So it's a decent correction. So it's possible we're going to find support around here, basically. The other sector of issue is the healthcare. This one has just been pressured stronger and stronger, and this one may have broken already below Brexit lows, because we closed at 67.78 on Friday, and the lows here were at 67.83. So it's possible we already broken below those support. Also, there is larger volume here, and that makes perfect sense because people hide their stops below recent lows. So basically, we took out the stops here. So this volume could be already indicating that it is indeed a bottoming action. Now again, I think that this is a bullish chart, and I think this is already more or less oversold. So I think at the very least some sort of a bounce may materialize from these levels, unless the entire market just collapses. Here's another one that's more or less back to Brexit lows, the minimum volatility fund. This one was also at all-time highs, so it came down rather hard, and kind of basically again at support more or less. Then here I wanted to show that even though this is a large volume, does not necessarily mean that this is indeed the bottom. And here's a good example of that. USMV, you can see there was an enormous volume spike here in October, around right there, and it did not indicate a bottom in prices. In fact, we broke below those prices. So I would read bottoming, I would read volume kind of with a grain of salt. They could be interesting and useful, the volume patterns, but they're not necessarily 100% guaranteed. Here's another industry group which came down pretty hard, also more or less a little bit more interest sensitive than the rest of them. That's Homebuilders, again also back to the Brexit lows, and we'll see where this goes. These are economically sensitive and interest rate sensitive, so kind of like a double whammy here. But to summarize, S&P 500, I think it's still bullish, especially if we hold support here. We could easily come back and re-challenge all-time highs. So this is TLT, 20+ year Treasury Bond Fund. We hit all-time highs here in July, and since then we're kind of coming down, making lower lows and lower highs. So right now on Thursday, Friday of this week, we made a lower low with a gap down and a break below October lows, additionally break below June lows. So this pattern doesn't look good, honestly. So there is indeed a possibility that these are, this all-time highs is basically as far as it ever going to be in the history of the United States bond market. Here's a longer-term time frame. This is basically a United States bond, the long-term bond, and this is going back 30 years. And you can see that it was rising for the past 30 years in this sort of up rising channel of some sort, and we hit more or less the upper part of the channel just a couple of months ago. Now we're coming down, so we'll see where it comes down to. But if we extend the channel, this could be quite a significant correction to, well, let's just estimate it maybe to like here, so that's 16%. So from the top, so it's possible that we're going to be coming down and correcting more. Whether or not this is going to be like beginning of a complete turnaround in the bond market, it remains to be seen, because there's a very long history of uptrend in the bond market. But for now, basically we can either short it or just stay away out of it, out of this market altogether. Here is a TLT on a weekly time frame, and I pointed out the support break a couple of weeks ago. We attempted to recapture that with last week, but then immediately were sold off, and this week's candle is a loss of 2.1%. So looks like the support break is valid, because we had 1, 2, 3 attempts so far to recapture it, and none of them succeeded. So looks like the support break is valid. Again, like, we can do a little projection, and these are all-time highs to the support, so we could easily correct another 6%, so we could retest the lows from March and May here at 125. Here is AGG, also doesn't look great. It's not as it's not as volatile as TLT, so maybe this is support already here at 111 and change, but then there are gaps here, and then there's another gap here, so we could easily correct more. And here's a weekly time frame for AGG, and this still potentially could be a pennant flag, and if we break out above the pennant flag, new all-time highs are possible. But this could already be a pennant flag break to the downside, and this does not bode well, and it could again, we could see a correction similar to TLT, but not as violent. Maybe it's difficult to say where to it will correct, but maybe to here, or possibly to even here. So maybe 3% correction for AGG. But this is a big deal, because they don't move as much. Here's municipal bonds. This one was kind of like a canary in the coal mine, and I pointed out the support, this support break right here in September. We attempted to recapture it, but then immediately sold off, and it was really perfect. You could see it from the lows in May, and from the support break it came down to exactly there, and then just sold off. So again, I would probably just stay away from muni bonds and bonds of all sorts, more or less. Again, here's municipal bonds, and that's a support break I pointed out, and we just continued lower. And here we can do a similar projection. This enormous spike here, so I'm not sure if I should count it, but let's not count it and be a conservative. This is 1.4% from the break, so we could easily come down to test the March lows for MUB. Okay, here is the US dollar on a daily time frame, dollar index. So we had a breakout here at the beginning of October, several retests of the breakout, and then a rally higher, and this is a daily time frame. Now looks like we had a rejection candle here a couple of days ago, with sideways consolidation, and finally a sell-off on Friday. So breakouts quite often, well, more often than not rather, do get retested. So it looks like we had a breakout, a couple of retests, but maybe we're gonna get another retest, and then we'll see where that goes. Again, several market moving events next week, and a big event the week after with elections, and not this coming Tuesday, but the Tuesday after on the 8th. So lots of opportunities for volatility to pick up. Here's that same dollar index. dollar has been sliding the entire Friday more or less, but then here when FBI came up with their announcement, it just kind of collapsed and then ended the day and the week near the lows here. For the week, the dollar lost 0.35%. So really, if the FBI didn't come up with an announcement, the dollar would have been more or less flat or even slightly up. But in any case, I think the dollar is in a long-term uptrend, and looks like we had a well, this to me looks like a double bottom, and we could easily break out above 100 level here and go higher. Anything is possible, and an alternative interpretation is also possible. We could come down here and break lower, and in that case, this entire bull market and dollar could be called into question. Here's euro versus the US dollar, and this one suffered one of the, it's pretty significant damage here. We can see we broke 3 support levels here, and one of them was rather important here from June lows, and we broke below it, and then so far 2 times we were not able to recapture the break, so it looks like we sold off so far. Here's euro versus dollar on a longer term time frame, and also it came down rather hard from 2014 and 2015. This is a bearish chart in my opinion. Strong move, consolidation, couple of rejections here, and possibly now we're going to re-challenge the lows here. Now there is some support at 10820 here, and also some support here, but I think if we break below 10820, we could easily re-challenge the lows at 10538. The British pound really didn't move much. We did get a very short-term break to the downside of this 2 consecutive inside weeks in a row, but not significant. Ideally, you want to see a close below this low, which did not yet occur. So, basically it's kind of trading sideways. We also could see a rebound to maybe a broken support at 1.28 or maybe even higher to 1.34. But generally speaking, on a longer term time frame, this is clearly a bearish security. And the US dollar versus Japanese yen, I think it has reversed. So in other words, before just in June, July, we had a clear downtrend in the US dollar versus Japanese yen. In other words, Japanese yen was appreciating versus the dollar. But I think now we have reversed, and now the dollar is getting stronger versus the yen. So if this is true, then it will help the DXY United States dollar index in the long term as well. And again, as I kept saying, the strong US dollar will weigh on commodities of all sorts, but precious metals in particular. Okay, so moving on to precious metals, this is gold on a daily time frame. Like I keep saying, the gold and the dollar move in opposite directions, so there's not much question about that. But in any case, we did broke below this support here, and then broke down to October lows. We may have held support here from October and rallied somewhat. Now it's kind of interesting, this action on Friday. You can see that we attempted to go higher, but so far we're rejected. In fact, it was on higher volume as well. So it's possible that the shorts are already coming in above this level here. In fact, if we go to a little bit more zoomed in, this is XAU versus USD. The resistance came in exactly above this candle from the 5th of October. And so far, I don't think there is a breakout above this consolidation. So we're still consolidating in the sideways manner. As far as the weekly time frame, 2 ways you can look at this chart. These are 52-week highs up here, and this is possible we're simply coming off of 52-week highs, so then we're going to resume our uptrend. The other way to look at it is if we break below $1,200, then we are certainly back in a bear market. and this is also possibly a rise in wage. And rise in wages after sharp drops could be a prelude for more drops ahead, especially if we break the rise in wage by, let's say, a close below 1260 at this point of the game. GDX, the gold miners ETF, still has bearish divergences that were not resolved just yet. Pointed those out here. You can see that we had a higher low here in October, but lower lows in the advanced decline volume, advanced decline lines, and unbalanced volume. Here is the gold miners bullish percent index, and actually we bounced a little bit, but then we sold off again at 17%. So this all smells of a possible reversal back into a bear market. Here's I think the biggest point of the news for this week is this is GDX in the weekly time frame, and like I said, the dollar dropped this week, and gold went up slightly for the week, but GDX actually dropped 3.29%. So I wonder if GDX is leading gold, and maybe we'll see a resumption of a further drop in prices for GDX and gold in the near term. Right, moving on to the hard commodities. This is light crude oil and a daily time frame continuous contract. So I kept pointing out this level at around $51, $52 with resistance in that area. Looks like we have reaffirmed resistance in that area so far. This consolidation, I'm going to point it out. I'm going to actually put a square around it. So this consolidation so far has held, or rather it has been broken to the downside. Actually on Friday. So this looks like a consolidation break to the downside. Whether or not it will hold is a good question and pretty much anybody's guess. But we have a peak here, which we're now closed below this peak at 49.36. So oil, in the long term, is still, in my opinion, clearly bearish for multiple reasons. But the biggest reason, of course, is United States producers and fracking technology, etc. United States can just outproduce pretty much anybody in the world, and we're actually holding capacity, and we're over capacity. So oil prices, I think, we're going to be either lower or sideways. I just don't see higher oil prices. There's just no point for that. Let me see what's anything on USO here, but USO pretty much follows oil prices, although there's quite a bit of slippage in USO, so it's not an ideal trading vehicle. Okay, and the natural gas. I'm using UNG chart today because there were some fluctuations in the price of natural gas, and spot price is a bit goofy right now. But in any case, in the daily time frame, we had a clear breakout here, and then continuation higher, and there's a 52-week highs. Now, it's absolutely normal to come down from 52-week highs, and with people taking profits, who knows where they were entering? Maybe they were entering down here, and now they're taking profits. So I think we are bottoming out. There's quite a bit of volume in this area here over the past 3-4 trading days. So maybe we are already finding support here, and then we'll kind of bottom out and then see higher prices ahead for natural gas. Here's a natural gas in a weekly time frame, and I pointed out that we're most likely going to be attempting to fill this gap here from 2014, which is what we did, and then the selling came in, and there's resistance up here as well. So so far, I think it's still very much a bullish chart here on a longer term time frame, because we had resistance here at $2.50, breakout, consolidation, or a pullback, and then a surge higher to 52-week highs. Now looks like we had a retest of this breakout again, and so far looks like we have held that retest. So I think higher prices ahead for natural gas. And finally, I wanted to introduce to some of my listeners who have not heard about this or have been hesitant about this. NADEX, North American Derivatives Exchange, it's basically an exchange similar to New York Stock Exchange, where people come to trade binary options and spreads. So binary options, you can read about them, but basically it's a yes or no proposition. You can say yes. For example, here's a chart of euro US dollar. You can see multiple strike prices for various contracts. So you can say that at expiration, for example, here at 5 in the morning, will the price be above this level? And if you say yes, you can buy this contract, and you can win up to $100, but you can also not lose more than $100. So it's a very interesting concept of trading, because your downside is kept. The critics would say that your upside is also kept, but I think that for certain markets this could be actually a very useful, for example, for futures market, where you have very large leverage, and for beginner traders, it's kind of difficult to estimate where the leverage will take you. So sometimes it's better to be able to limit your downside. But in any case, I have been trading on NADEX for quite some time now, and with decent results. So in the future, I'll be potentially introducing a service for NADEX. So if you're interested, do sign up at MasterChartsTrading.com. That's it for this week's recap. Thanks for watching, and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now. So please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling, and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the success as trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trade alert services. Bye-bye.